It's good.
Great, let's go.
Okay, Charlie, let's take it away with the bold chart book. And let's begin with this slide. What do we see here?
It's a very simple one, this one, Jacob. You got Bitcoin over the last year. It's a crazy thing. Bitcoin goes from 100, if you invested $100 a year ago, you briefly had 220 or so, and then now you're at 78 from the beginning. I think that what's amazing is that Bitcoin, people say how terrible it is, and it's taken the limelight of this crash. It's taken it away from government bond markets. And if you look at the long bond in most countries, particularly in European markets like UK or Austria, they're down on the same amount as Bitcoin in dollar terms, with currency losses and duration losses. So that's quite amazing. Gold's been very stable over the last year. It's fallen slightly, but not much. Don't forget the dollar's up a lot this year. And gold puts them together in a risk-weighted manner, and gold has been remarkably resilient.
What's happening to the dollar?
Well, it's rate hikes, isn't it? And I think that the rate hikes are going to start cooling because the economy is going to fall off a cliff. And it really is looking bad out there. And the bond market's telling you that it's actually stopped falling now, finally, and it's starting to pick up again. And that's because investors know that there's a bubble in equities still. Maybe not such a big bubble as there was a year ago, but there's still a bubble. And it's a problem. It's a real problem. And so the bond yield, which is now closer to 3% in most places, is actually quite attractive when you think you've got financial mayhem around. Tough times. I think the other thing, Jacob, we mentioned the fact that Bitcoin and gold, what are they? They're the world's two most liquid alternative assets together. And I think that's really important. So hopefully we'll get to that. We'll talk about that later.
And staying on with the dollar for just a second, is the dollar getting weaker or is Bitcoin and gold getting stronger?
I think if the dollar goes down, that's going to help Bitcoin and gold. It's going to help all things like that. There are other factors too, of course, as well, of course. But I think that the dollar's got to be near a peak. And I think that probably the peak's already behind us. It feels that way. It's very overbought. As I said, the rate expectations are overdone. And the dollar's not some superhero. It's a cyclical currency like everything else. And when it goes up, that causes pain. And now easing is going to see it fall. So the world's going to change on the other side of this. And hopefully, weak dollar environment should be good for the likes of Bitcoin and gold.
You write here on this slide, the reports of Bitcoin's death are greatly exaggerated. So I just Google death of Bitcoin. And I know there are a few obituaries. Here's one of them. The number one database of notable Bitcoin skeptics. Of course, we have a graph here on the price historically going back to 2011, and then a nice little table with all the Bitcoin deaths. Now, can you tell me who says Bitcoin is dead?
Oh, I think that most of the press. And I think that what's hilarious about this is it's deflected. The crypto crash has deflected attention away from the real crash. Crypto's lost 2 trillion. Yeah, great. Sorry about that. So what? Crypto does that, doesn't it? But the bond market, the equity market, they've lost trillions, 35 trillion probably in total financial losses. And the good old crypto saved everyone, saved the government, saved financial institutions by taking all the back.
Let's move to the next slide where we compare bold one index and the major stock markets during the past year. Talk me through this.
Again, it's a US dollar slide. If you want to put that into pounds or euros, just add 12% or so. And basically, about the correlations of it. And basically, gold was pretty steady until April when really everything came under a lot of pain. But it is ahead of the stock market. I think that people assume any index with any Bitcoin in will be below the stock market over the last year, but it isn't. And the best market actually has been the S&P, which has been a theme of this cycle. It wasn't between 2000 and 2008, the S&P would have been at the bottom of that list. But it's only really post-crisis that the S&P is seen as some super-duper market. So I doubt it will be in the next cycle. But emerging markets have been very weak. Their bond markets have sold off very aggressively. And everyone else is in the middle somewhere. The point is, the Bold One Index is resilient. Because when you've only got 20% Bitcoin, what's the most you can fall? Not much.
And in this graph, if we look at it closely, the blue line is bold and it's on top, as it is in most of your graphs. From here, if you look at October 21 to November 21, that's one time period where bold starts to perform much better than the equity markets. And then also in this period of February to March and April, it also performs better because you see this group of stock indexes going down, whereas gold goes up.
Yeah,
Right.
When you've got a falling competition and you're going up, that's the best time in the world. That's pure alpha. So there was a real alpha surge, and I think that was really, you can attribute most of that to gold. The Bitcoin actually behaved quite well earlier in the year. It was only Q2 it was really horrible. Yeah, I think that Bulk One is genuinely different. And yeah, zooming out over, it's exactly the same chart, 5 years, 3 years. The S&P green, Bulk One, the big blue one that's on top. There's this sort of natural correlation. It looks a bit like a risk asset, but it just has a better Sharpe ratio because the volatility is pretty low. I think we'll come to volatility later, so we'll park that for now. Emerging markets consistently the week, everyone else in the middle. But I reiterate that Bulk One is a portfolio. It's a diversified portfolio. In the same way a 60-40 index is a portfolio. It's not two assets. It's bigger than that. It's not like putting French stocks next to German stocks or Japanese stocks next to Chinese stocks. It's two completely different things, which behave beautifully. And it's alternative, so it's not part of the financial system. It doesn't pay a yield, which is a good thing if you want an alternative.
We'll get to the liquid inflation hedge that you mentioned in just a moment. But first, continuing with the historical performance, now shifting from the equity market to the bond market. Again, gold is on top of this chart.
Yeah, so if you look at the emerging market debt there, I think we've also got the long gilts. The long gilts are...
Yeah, at the bottom there we have UK index-linked gilts, and it went to 67.
Yeah, so some of these bond indices have been nearly as bad as Bitcoin. That's my point. And it just hasn't got the attention that it really deserves in the mainstream press. It might have got it in the financial press, but not in the mainstream. So I think people, I reiterate, they just happily go and blame Bitcoin for being the sole trouble and everything else is completely normal. It's not.
This goes from July 2021 to July 2022. And clearly, all bonds here, they're suffering. 20+ year treasury bond, Invesco's emerging markets, high yield bonds, everything is suffering.
Yeah. And by the way, if the dollar does peak, then emerging market bonds look really interesting. And that's traditionally what happens, because a rising dollar puts pressure on them and a falling dollar lifts them.
Here's a valuation, and you talked about gold being undervalued before. Can you explain a little bit on this Morris gold fair value, which is the black line, and in yellow we have the gold spot rate, but how do you calculate the fair value?
Yes, I was sitting in my office in HSBC in 2013, just before the bond train wreck. And I said, there must be a way to, and so that was the taper tantrum. Remember, the Fed was going to raise rates in the bond market. That took a beating, but equities liked it back then because growth was coming, right? This time growth is going, and you've got the height, which is different. And I started modeling gold, trying to understand what it was. And you've seen the gold versus CPI chart that's all over the internet. And then you see the real rate, 10-year real rate relative to gold. And I said, okay, how do we combine these two ideas, which were becoming increasingly accepted 10 years ago, of how to drive gold? And I'm saying that gold's got a past, a present, and a future value. The past value is basically inflation that's already happened. So last month in the US, CPI for June was 1.3%. What does that mean? It means 1.3% goes straight onto the gold price forever, because you get compensated for the debasement in the purchasing power of money. Part two is the present value. So that is the real interest rate. You also see people talk about the real interest rate, the difference in inflation expectations in the future and the bond yield. And gold moves inversely to that. And it's quite logical, because if interest rates are 5%, yeah, and inflation is 0, then you would queue outside the bank to put your money in. Because you'd say, thank you, I'll give you money, you'll give me 5% back, and inflation's 0, so that's really good. But if inflation was 10 and the bank was offering you 5, you'd queue outside the bank to get your money in. And that's when you'd want to own gold. So if that simple idea that when the bank is giving you a negative real return, then you want to gold. So gold trades inversely with that pretty accurately, as you can see in this model. And the final point, which is a bit more controversial, but it's the same basis of how inflation-linked bonds work, is you're looking at the future value of money. And so if you're saying that inflation is going to be 2% per year for the next 20 years, that means the value of your currency is going to halve over that 20-year period. Gold also compensates you for that. So you get past, compensation, a present value, and a future value. Those are brought out in this model, which basically at 20-year tips, because it's dollar. You could do this in euros, gold and euros with a 20-year euro inflation equal if you wanted to. But because dollars are the main source of liquidity for the gold market, it tends to work best on this basis. And the difference between those lines is the gold premium or discount. So in mid-2020, gold was overvalued quite significantly. And at the moment, it's about 6% overvalued. But at the beginning of the year, crucially, gold was a discount. So gold started the year about 16% cheap. And that's why it did so well in Q1, because even though the fair value of gold went up, but as that's come down because interest rates have been rising for the last 3 months, gold hasn't had as much punishment as it could have done because it started the year cheap, basically. So if the bond yield goes down from here, which I think it will, and the dollar softens, that black line goes up and supports.
You're right that gold was one of the few undervalued assets in 2021. But when I look at the 21 here, the black line, the fair value, is above the spot price.
Yeah, so gold was undervalued at the end of 21.
Yeah, at the end.
Yeah, so when the gold price is below the black line, that means gold's cheap. When the gold price, like mid-2020, gold's expensive. When the gold price is ahead of the fair value. That's gold overvalued, and the following year is gold undervalued.
Okay, got it. That makes sense. And you also write here that inflation is not accurately recognized. If I was a news anchor, I would ask you, is the reported inflation fake? But I'm not. I'm asking you if inflation is not accurately measured.
No, I believe inflation is accurately measured. I'm not in the gold. I've never been a gold bug. I've been a gold analyst, and I've never been anything bug. But my children probably wouldn't say that. But it's the bond market's recognition of the long-term inflation outlook. Now, in the short term, inflation is coming down. And it's pretty obvious the economy is going to get crushed. Commodity prices have done. The supply thing that we had to worry about after COVID, that seems to have cooled down. And people aren't going to buy new cars in the same way they were a year ago, or they'll start cutting back on holidays and things. So I think the inflation is going to cool. But the question is where the next low is. And I suspect over the next 20 years that inflation is much higher than the bond market currently thinks it is. But that's not going to change this week because we're in cooling phase. The next bull market will know more.
Let's move on to Bitcoin then. And here is a plot where you go from 2013 to this year, and you plot the Bitcoin price in black. On the y-axis, you have the dollar amount on a log scale, we should say, because otherwise it would go through the roof and we wouldn't be able to analyze. So it's on a log scale. And then at first you think that the red is some form of moving average, you're smoothing out the black line, but no, the red one is the fair value according to your valuation of Bitcoin.
Correct.
So can you describe that valuation model? I think it's based on the network, but let's dive into that.
So ByteTree.com, what do? One of the things we started doing was analyzing the Bitcoin blockchain on a block by block basis. And we taken each block and stripped it apart for information, trying to understand if there's any economic value in that information. And I was hopeful in 2013 when we started doing this project that it would be full of treasure trove, full of information. And I think that's been part right. You know, there is a lot of information in the blockchain, perhaps not as much as we'd like. There's a lot of useless information. But I think that the most important thing, to my mind, is the accurate measure of transaction value. Now, the Bitcoin blockchain does not give you this information. You have to go and calculate it. We processed 750 million transactions to do this. And we projected some of the transactions were designed to obfuscate, for example, the mixing traffic for a criminal. We take that out, that's not economic, and another couple of technical transactions that don't fit the bill. But basically, normal transactions, we calculate change. And so that's what happens on the blockchain. If I'm giving you 5 Bitcoin, then I might find a 10 Bitcoin note inside my wallet, and it will give you the 10 and then give me 5 back. It's a complex way of doing it, but it's how it works. And so you have to go and net that off. You have to make some estimates. And I believe that ByteTree's got the most accurate transaction value number out there, and you do it live. And when you've now got a number of how many dollars are going across the blockchain each week, it's about $30 billion typically going across the blockchain each week. It was nothing 10 years ago. It's grown and grown and grown along with that red line. But it's quite a volatile number. You've got to take 7 days because the weekends, basically, the blockchain slows down. So every multiple must be 7-day average. And we take 12 weeks, so 12 times 7. And because otherwise the line is quite volatile and it gives some sort of anchor. And I think what we're saying is the difference between this bear market and particularly the 2014-18 bear markets, the amount of dollar value going across the blockchain collapsed on those occasions. This time hasn't. It's stayed very resilient. And there's a calibration that basically the amount of money, the on-chain volume in dollar terms is highly correlated to price. And some people say, oh, price moves. Yeah, it does. But it is true that the price does change the value. But if the price goes up, you also see a reduction in the amount of value going across because people haven't suddenly got all the money. Does that make sense? And when the price collapses, the same could happen. And so you find that there's a calibration between what the price ought to be and the amount of network activity there is. And here it is. And the relationship between them is in this case, it's a 12-week model. So we're taking 12 weeks of traffic to get our red line. And on that basis, the coin's trading a little bit cheap. I think I published when the price was probably 22,000. It's now 3,000. It's the best part of 20% undervalued.
Your Bitcoin model is hugging the price much tighter than the gold valuation model on the previous slide.
Yeah, it's not the model. That model going back it goes back to 1998. It's got an R squared of 0.86. It's pretty accurate, much more accurate than the Bitcoin. But what you're saying is that it's not tracking the price because the price was at a premium of where it ought to be. A fair value model is not there to decide what the price is going to do because when an asset goes to its fair value, and then there's the crowd. For some reason, the crowd wanted to buy too much of it. If something's worth 100, but a million people want it, then it's now worth 200. It's as simple as that. And the wise trader will say, well, actually, it's only worth 100. I'll just wait until I can get one.
Yeah, you're pointing out the difference between a forecast or prediction on the one hand versus a valuation on the other hand. And sometimes they're very different.
Can be, yeah. In a bull market, Bitcoin's always going to go too far. But this is the beautiful bit, Jacob. This is why gold's so amazing. It's because you've got these two assets that really struggle to be in a bubble at the same time. I like this because I created this chart. What do you think about it, Jacob?
Yeah, I think that, as you said, you can clearly see that if you take this graph and you break it up into different periods, where you study it, for example, 2018 here, then Bitcoin premium is high, gold premium is close to zero. And then we move on to the mid 2018, Bitcoin premium is high, gold premium is negative. Again, pointing towards your conclusion that they are not overvalued at the same time. When one is very high, the other tends to be very low. Again, same for 2021. Bitcoin is overvalued, gold is fairly valued. And then during 2022, Bitcoin is overvalued and gold is undervalued. So that's why I wanted to dive into your different models here, where you value Bitcoin as from the network perspective, and gold being part inflation, part rates, and provided that your two models, your valuation models, are decent, then yes, we definitely arrive at the conclusion that they are never overvalued at the same time. And that's a pretty powerful combination to have in a portfolio.
I think so. And what do you think of gold, not just as a ticker, but as an asset class in its own, and Bitcoin, not just as a ticker, but as an asset class in its own right? It doesn't need the rest of crypto. The rest of crypto makes it worse. It makes it less liquid and more volatile. If you put silver and all the other stuff next to gold, it makes it less liquid and more volatile. So actually, I like to think of it as two asset classes, with Bitcoin playing the role of equities and gold playing the role of bonds. And as we'll see later, both of them prefer inflationary times. So there's no doubt that the gold index would prefer inflation. But on the other hand, it probably is pretty happy with just a soft dollar. So provided the dollar's not going through the roof like it has been in Q2, then maybe these assets will have a better time.
I don't see Bitcoin as its own asset class and gold as its own asset class. Instead, I see Bitcoin as a member of crypto assets. So that is the asset class. We have crypto, And then gold is precious metals or commodities. I would probably put in the commodities asset class, because when you talk about asset classes, you don't want to have too many in the entire world. Otherwise, the concept is, I think, less useful. So if we go with saying that gold is an asset class and Bitcoin is an asset class, we actually end up with too many asset classes, and that taxonomy is not as useful as saying gold belongs to commodities and Bitcoin belongs to crypto.
Look, Jacob, I totally agree. You probably what I meant to say is that gold is the highest quality commodity and Bitcoin is the highest quality crypto. And as for asset classes, there aren't many. There's basically bonds, equities, real estate, commodities, and crypto. And I think there are any others. And people start making up all this rubbish like private equity or infrastructure, and they're just equity, really. And again, debt is just debt. I think that there are far too many pretend asset classes out there, where there only are very few. That's why I got so excited about crypto, because it was a new one when I discovered it in 2013. I went, wow, new asset class, that is a big deal.
Yes. And how excited were you when you created this chart? Does it hang on the wall in your office at home?
This chart?
Yeah.
No, but I might get someone to come paint it for me. The problem with probably charts on the wall, if they don't update, they're going to be on your computer.
Okay, moving on to the next one. What do we see here?
So I've just taken 80-20, 80% gold, 20% Bitcoin based on the previous chart. And I said, okay, put those two together and what's the fair value of the combination? And right here, right now, it appears to be on fair value, which is great.
I actually wrote about this chart in the monthly newsletter, but I took it from you. And so here, I think this is a pretty strong argument for why gold is an inflation hedge, because on the red line, we have the 10-year US break even. And in blue, we have gold. And we see from 2020, they go together very well. However, why don't they 2017, 2018, 2019?
They do in 2017. They're going up together. And in 2018, they're going down together. And in early 2019, they're going up together. And it's only really the 6 months before the COVID crisis when they went their opposite directions.
So if you were to make two graphs, one with the left-hand side, and then you cut out a tiny slice in the middle, and then one graph with the right-hand side, then you would get two nice-looking graphs.
Yeah, with a mistake in the middle. Absolutely.
Okay.
I think what's interesting about it, and when I highlight it, I'm not saying gold one is a perfect inflation hedge, but nothing is, right? But everyone's criticizing gold for not being an inflation hedge and Bitcoin for not being an inflation hedge. Over the last 2.5 years, total inflation's been about 14%. So if you've gone up 14% or more since the beginning of 2020, you've hedged inflation. Both Bitcoin and gold have done that, as most stock markets have as well. So actually, it's a strange one, but people want an inflation hedge that if inflation is 10%, they want it to go up 1,000%, and they want it to do it every day.
And it's not a day-to-day hedge. It's looking at this in the long run, like 3 to 5 years.
One of those sort of crazy financial conversations we have to put up with.
Okay. And here we have another plot where you have the CPI, the Consumer Price Index, in red. And then you have a bunch of different inflation swaps, 2-year, 5-year, 10-year, 30-year. Maybe it's worth mentioning that inflation swap here is very simple, fixed for floating. All of them right now are between 2.5 and 3.5. So what's the takeaway on this graph?
So they're between 2.5 and 3.5 when actual inflation is above 9. And so this has been one of the confusing charts over the last year or so, because it's saying, why has the bond market never believed this inflation? And the central bankers have all been saying inflation is transitory, and the bond market believes them. I think the gap's going to close, but it's not going to close yet because we're in a downturn. So the inflationary forces are coming down. But I just don't think that red line is going to come all the way back down to 2%. That's just a personal view. I think it's going to settle down somewhere between where it ought to be, 2%, where the central bankers want it to be, and where it ought not be, which is 9.1% up there. So it's going to settle around.
Where do they meet? 6, 4, 5, 6?
Yeah, or the next cycle. And so that's what happened in the 70s. Inflation went up very high, came down, and went phew. And then it started going up again when the economy expanded. So I think that's one of the things we've got to watch out for in the next cycle. If the inflation doesn't come down as quickly as people think, then the whole idea of inflation hedging becomes relevant.
Let's revisit this in 6 months and 12 months to see if they have converged.
Yeah, it'd be like watching a snail race, wouldn't it?
Yeah. This is a very colorful graph. So 2017 to 2020. And on the y-axis, we're looking at the 90-day volatility for different assets. In black, we have Bitcoin. In blue, as always, we have gold. And then NASDAQ 100 stock index, iShares bond ETF, and then gold in orange. So what's the conclusion?
There's a number of things about this. Volatility is a measure of risk. It's not the only measure of risk, but it's one measure of risk. Really, we care about capital lots more than volatility, but nevertheless, it's a useful thing to look at. I've highlighted the areas in red, which are equity bear markets or equity bulls, so end of 18, the COVID crash, and much of this year. And you see how the NASDAQ in purple, the volatility goes up quite aggressively during sell-offs.
Yeah,
and
the first period here, end of 2018, the purple line goes up a lot. So NASDAQ 90-day volatility spikes, and same here in early 2020, it spikes and it stays there for a while before going down to its sort of normal levels, a bit elevated, but still there's a very high peak here, and the same in 2020 or end of 21 and first half of 2022, it goes up as well.
Yeah, it does. And what's amazing is how equity volatility picks up, but gold doesn't. Gold doesn't go up much. And that's you expect that because it's not part of the stock market. Coin volatility tends to go up along with the stock market, but gold doesn't, which is amazing. So it maintains lower volatility during equity bear markets than in bull markets. And look at the blue line. There's more volatility in the white bits than in the red bits. And I think that's because during bull markets or benign environments, gold goes down and coin goes crazy. And so gold becomes more volatile and it's more stable, ironically, at times of stress, which is a strange thing. But I also finally want to mention the Bitcoin volatility in the previous cycles. In the split and bear markets and stuff, we've seen it's been much higher than it has been this time, despite this big fall. 70% for Q2 that we've seen is really nothing compared to the past. So Bitcoin structural volatility does continue to fall. Let's remember it was 150% just 10 years ago. And
if you were to take an average, let's say the first 3 years, what's the average level here? Something like 80. And then the last 3 years, what's the level then? Something like 60. So going from 80 to 60, you can also see that over time, the Bitcoin volatility goes down as is expected for a new asset. Now, the first red period here, Bitcoin volatility went up a lot. Second period as well, it went up a lot. But the third period actually stayed pretty flat.
It did, yeah. It did. That was really the Q1 performance wasn't bad, but now the Q2 is coming through. That's the problem there. Gold still doesn't go up.
For me, what would be really interesting here is to not graph the volatility, but the downside volatility. So just like in Sharpe ratio, you use the volatility to calculate the risk-adjusted returns, whereas in a Sortino ratio, you use the downside volatility. So you only look at the days where the prices went down, because if prices go up, yes, it's volatile, it contributes to the standard deviation, but who complains when the prices goes up? So I think it's very interesting.
Jacob, the short sellers will complain.
yes, but this is a long only portfolio. So I think if we take a sort of asset allocator's perspective, perhaps coin's volatility would not look as frightening, because we know that Bitcoin can be pretty volatile on the upside. Now we see that gold, interestingly, has a very low 90-day vol compared to indexes on the equity market as well as the bond market. And what I think also is important with this graph is that volatility is actually a key input parameter in the bold one index, because we put an equal amount of risk into gold and Bitcoin. The volatility is dictating the weight per asset in the next rebalance, and it's rebalanced monthly. So whenever Bitcoin's volatility spikes up, we actually reduce the weight in Bitcoin.
Yep. That's the main input, isn't it?
Yeah. Exactly. So that's why this graph also can help investors understand how the bold one index behaves and why it does. Why do you get a higher rebalancing weight in gold a certain month? It is, of course, depending on the volatility a lot, because that's what goes into rebalancing weights, but also what happened to prices. Let's go to the next chart. And I think this is a very interesting one, because you're looking at shocks, periods when the market reacts very quickly. And for that, a measure like 90-day volatility is a little bit slow because you're using a quarter's worth of daily data. Whereas here, you're looking at the VIX and it reacts instantly. So what do we see?
What we've got in the bold portfolio is 80% in gold, approximately, and 20% in Bitcoin. So when things are going badly, when Bitcoin is going down, it can't lose more than 20% in a month, can it? Because Bitcoin goes to zero, it goes to 20%. That's 20% loss. So the stock market can go down 50% in a month, 80% in a month. It's possible. But gold can't, assuming gold holds up. So that's one quite interesting thing on the risk management side.
Yeah, the value at risk, you would argue, is the allocation in Bitcoin, which is roughly 20%. So that's your max loss.
Exactly. And in a single month. And on the other side of that, 80% of gold's a lot of gold. And gold normally has a bid when there's a panic, even if the price of gold is overvalued or what have you. People come running to the gold market and for safety. Now, gold can sometimes fall during a market panic, but it won't fall very much when the stock market will fall. And so that means in this case, we've got outperformance. So that black line is actually a relative chart. It's not the bold index. It's the bold index relative to the world. So it shows you that the bold index outperforms the world index, the stock market, during times of stress. And that was true in early 18. We had a VIX spike. It was true in late 18 when we had a nasty market. We just talked about that. It was true in COVID. And this year has been a bit funny because we haven't actually had a stock market VIX spike, despite being the worst quarter for equities for a very long time, or the first half year for a very long time. And that just tells me it's not over. That, to my mind, because we haven't had a panic yet, just means we've got another wave coming at some point. The stock market's full of short money. Everyone's short. And everyone knows how bad the story is and how overvalued it is. And so everyone's short, and then all the hedge funds are short, and so therefore it can't go down. So you've just got to wait for that to flush out. It's a bit like the summer of 08, where there's an extraordinary sort of rally, and it turned out to be completely fake, and then the market collapsed. So I think we're going to have one of those. But what's interesting about the bold index, most of the outperformance has come during stock market downturns, first conclusion. And then second thing, it's actually done quite well during booms. So there's a smile to it. It likes a right tail. It likes a left tail in derivative speak. And it doesn't like calm. And it's underperformance of bold. It's happened during benign stock market environments. The outperformance this year came during the worst of the panic, and it's been cooling of things to calm down, basically.
And that sort of smile that you mentioned, it performs well when the market is doing great, and it performs well when the market is doing really poorly. That's a fairly unique combination.
It's completely unique. That's why this isn't just an asset A and asset B. This is two magic assets with special, uncorrelated, negatively correlated qualities. And they're both often non-financial. So when the financial system's in trouble, guess what? Alternative assets outperform.
Yeah, and that of course makes a ton of sense. Now, your phrasing is dangerously close to magic internet money.
It is a little magic real money.
Yeah. Looking at this one, is World the MSCI World Index?
Yeah, MSCI World.
Yeah, and that's the broadest equity index that has a substantial amount of AUM in the ETFs that is tracking it. It's broader than the S&P 500. So I think MCI World should be a bit of a benchmark usually because people are too US centric when they make their financial analyses. So this is a proper world index. Now the relative peak, if we look at the VIX spike here, bold versus world doesn't go up a lot, but during this period of late 2018, we see this pattern. And for me, the one that really pops in when you look at this chart is early 2020, VIX through the roof, and so does bold versus world. I think this is a very nice chart. And let's go to the next one because, again, similar behavior, but now we're not looking at the VIX in red, but instead we're looking at the bond spreads.
Yeah. So bond spreads have been widening this year. It's the outlet for the economy, basically. And can a company repay its debt? And normally we ask the stock market question, the greedy one is how much their profits are going to grow. But in this one, we say, can they pay it back? It's a very different question. And the risk is low when the red line's low because people say that, yeah, they can pay it back, but they're not paying you much. But as there's more stress, then they have to pay you. And so that's been going up. Again, you've got a very similar pre-2020 COVID stress. And I think, funnily enough, you've had a lot of stress in emerging market debt, we talked about earlier, and in high yield debt. But in this sort of higher quality BAA, so that's basically profit company blue chips, basically. If you were to look at this one, you haven't had a non-stress up there yet. And that's probably why we haven't had a VIX spike this year, because we haven't had much stress in blue chips. The the stocks in the ARC ETF have come down a lot, but the stocks in the big indices haven't. So
tech and bold, risk on.
Risk on. This is my smile. This is the other side of my smile. We just talked about the left tail, as in the dark times. This is the good times. And gold is more likely to go up when tech is outperforming normal stocks. So the gold index in cash, just in dollar value, and then when Nasdaq's outperforming S&P, that has tended to be the time when gold does best. So in relative terms, it does well during the bad times, and in absolute returns, it does well when in a strong risk-on environment. As I said, it's the smile, and it's the benign environment where gold doesn't do so well. Probably because it hasn't got a yield. When you've got a yield, things like corporate bonds do very well in a benign environment because everyone likes to collect those coupons. The bonds has a different characteristic to that.
In the red line, we see Nasdaq relative to the S&P 500. The S&P 500 is dominated by FANG, which are tech stocks. And I don't know what the weight is if you take the sum of the Facebook, Amazon, Alphabet, Netflix, but it's a substantial weight. And if you then take Nasdaq relative to S&P 500, do you get small cap tech stocks, or how should I think about the red line here?
The weighting of those same stocks you mentioned is much bigger in the Nasdaq than it is in the S&P. So you're just getting the tech outperformance, basically. I could this if I did the tech sector against equity momentum against the world, I'd probably get a pretty similar picture.
And here you're not measuring how much Bitcoin costs in dollars. Going back to one of the earlier questions I had on, is the dollar getting weaker or is Bitcoin and gold getting stronger? So here you put Bitcoin and gold versus each other to see how much gold does it take to buy a Bitcoin.
Yeah. So once upon a time, I remember someone on Twitter the first time who said, Bitcoin's worth more than an ounce of gold. This was about 2017 or something. And it crossed the 1 ounce for the first time. That was a bit of a story at the time. But it went on to become 35 ounces. And it's retreated all the way down to 10 ounces. And clearly you want to go against this line after a big move like that. It wouldn't shock me if Bitcoin beats gold for the next couple of years. There are lots of reasons for that. I don't think gold's going to do anything particularly exciting whilst inflation stays soft, but it's not going to collapse by any means. It's just going to probably not do much. Whereas Bitcoin's got every opportunity to climb back to where it came from over the next few years. So yeah, I'd buy that chart.
When the dollar dies, maybe this is the only graph people will look at.
Maybe.
Okay, let's talk about bold. The bold index, the Vinter ByteTree Bold 1 index is the full name. Here you have done a classic management consulting style plot where you have inflation on one axis, high inflation, low inflation, and risk on, risk off. Talk me through this one.
I call this the money map. I've been using this tool for 15 plus years. Now, obviously, Bitcoin wasn't in it 15 years ago because Bitcoin doesn't exist, but I would have value in that. Normally, I would have gold, and value would be commodities and financial stocks. And equities, you could change that to growth, and bonds, it could be bonds and high quality stocks, something like that. And gold or inflation-linked bonds. So there are different ways to interpret that, different ways to populate the quadrants. But basically, when inflation is going up, gold and Bitcoin are going to beat bonds and equities. And when inflation is going down, as we've already shown, the bonds and equities are in a better position to outperform gold and Bitcoin. And when things are going really well, Bitcoin and equities do well. And when things are going badly, gold and bonds are a better place to be. So this is really putting together the two liquid alternative assets that are natural inflation hedges because of their sort of dynamic. You can't print it. And one's naturally risk on, one's naturally risk off, just like bonds are supposed to be risk off. And not this year, but that's in normal circumstances. And equities are supposed to be risk on. We're building a portfolio with these two assets, then you can compare it to a 60-40 balanced portfolio, which I think is pretty interesting. And we've also shown you can't really get gold and Bitcoin in a bubble at the same time, but we did manage to get Bitcoin, bonds and equities in a bubble at the same time because of central bank behavior. Now that didn't, because Bitcoin and gold's drivers are naturally opposite. It's only ever going to impact one of them, not both. So I think that's quite interesting, just differentiation between gold and a 60-40.
And here you have this comparison once again on gold versus the 60-40. And you say that it has delivered a 11% per annum excess return, and it comes from rebalancing and superior asset mix. How do you calculate the rebalancing of 6% to 7%?
The 11% outperformance is shown because if you have a period like that of 7 years or something, go 100 to 200 and something, then that's 11%. That's done. How's that broken down? You could measure Bitcoin and gold over the periods and split the difference, or say I started with 80-20 or what have you. There are various ways to do it. But what I've done is I've taken the Bitcoin and gold chart and I've looked at periods where the return has been the same. And I've done that with several different measures. And so when you've had both gold and Bitcoin up 40%, let's say, or both down 20, what's the difference of gold over that period? And what's the difference of that asset mix? And the average outcome is 6-7%.
And then you compare gold with a monthly rebalance and gold roughly 80-20 allocation without a rebalance. And then you get an outperformance of 6-7% between those two things.
Sure. And then you have to decide whether you use today's weight or then's weight. And of course, the weight of Bitcoin in the product in the beginning of 18 was quite low because volatility was so high. So what weight you use at the start, it's actually quite complex to come up with an answer that's going to please everyone. But I know that this 11% is broken between power of rebalancing and the asset mix. It can't be anything else. And that exercise I just described comes to 6 or 7, which means the residual is 4 to 5 superior asset mix. Now, it could be that that's a Bitcoin and gold both underperform bonds and equities. And in a higher interest rate environment, in a high real interest rate environment, you expect that probably true. So if we had real interest rates at +4, like they were 20 years ago, that today they're 0, if they're at +4, then you can make that claim. You'd only get the power of the rebalancing transactions. The superior asset mix argument might go into reverse. With any event, you've got something that looks like it can hold its own, even in a high real interest rate environment, which I think is pretty interesting.
Last slide. These are the returns, the yearly returns for a bunch of assets, and gold is doing pretty well.
Yeah. So the way it works is this is a classic financial sector chart when you're looking at asset returns, and you show the best and worst of each year with the color. And so lots of red is bad and lots of blue is good. So in 2015, Bitcoin was great and crude oil was bad. And I think what's interesting about this is that Bitcoin, out of the 8 periods, and 2022 is to the end of June, but 6 out of those 8 periods, it was the best asset and the other 2 was the worst. So Bitcoin is never in the middle. It's always an outlier. it seems. And gold tended to be somewhat red when Bitcoin was doing well and somewhat blue when Bitcoin was doing badly, which again kicks in the negative correlation. This year, gold would have been blue, crude oil has taken that. But of course, crude oil didn't do that in 2018 because there's no link there. But the other point is, obviously, the assets have done well. But what I would like to say is that gold, the combination is never red and it's never blue, a bit like Swiss equities. Everyone loves Swiss equities because they're deemed to be high quality. They're bond-like. They're deemed to be a good currency, good country, good companies. And it's a real sort of gentleman's index because it's nice and calm. And bonds like that. It just makes more money. I think that there's something very special about this asset combination, the fact that the volatility stays low, like Swiss equities.
Yeah. Swiss here, bold there. Bold is like the Swiss, but makes more money. It's a nice summary. And we're actually just in time. So this was the bold chart book. And Charlie, thanks so much for talking us through this one. If you want to learn more, you can go to this link over there, which takes you to the bold index on bytreeam.com or vinter.co/bytetree, where you can read a methodology doc. And that was it. Thanks for today.
Thanks, Jacob, and have a great